May 2025 IAL Unit 2 question number 4. The Tastee Burger PLC and SnakTime PLC are merging and forming Good Meals PLC. So here we are solving part E of the question. Evaluate the decision of the directors of Good Meal PLC to take over all the assets and liabilities at book value. Why don't they take it at market value? Why are they taking at book value is the question. Evaluate the reason. The first part we had asked calculated purchase consideration, realization account and sunrise shareholders account we had prepared. So we can see that whenever you are taking at the book value all the assets and liabilities, there will be no adjustments, okay, and it is all assets may be greater, liabilities may be less, so less of working. So you can say some assets would not be need to be adjusted to give a different market value, for example bank and cash. Some liabilities would also never need to have adjustments to give a market value. For example, you can give mortgages and trade payables, which are the liabilities you are talking about. Then, and if the market value of may be different and it is very difficult to agree, then it is difficult to put a value even on items such as fittings, which may be specially made for a business. So it is easier to just use a book value which is listed in the books already. But however, the case against it, we need adjustments because to the market value, and it should not be recorded at the book value, because we can see that the property prices might be increasing or decreasing. Certain adjustments. So now the new market price for the property would have increased tremendously, and but we might take the book value, and also some of the inventories okay might have got deteriorated, and we can see that the trade receivables also might have some bad irrecoverable debts. All these are not accounted, so you should be able to take the market value and not the book value. The computer systems may also be outdated, so we can say that. And not only that, you can include a point saying even the liabilities you take up, the interest rates might have gone up, okay, also there may be change. So that means you have to use the market value and not the book value should be your argument as given here, okay, because of certain factors which we discussed, like fittings, inventory, trade receivables and computer systems, okay. Because if we take the book value, these would actually market value would be very less, okay, and you are valuing at a higher value and you might be paying more for the all of those assets. The vehicle, okay, also may need revalue to reflect the condition and the usage, and it might be a second hand value of the market value and not the initial purchase cost which is listed in the books. So you can have these type of arguments, okay, and finally you have to give a conclusion. So like you can say, okay, at high cost, and even the liabilities might have interest, okay, interest which is liabilities may be now at a high cost because of the interest rate, it might have increased, okay. So your value, if you take the book value, might be valuing the liabilities at low cost, okay, that might happen. So it is that is the case for against taking the book value or the carrying value and not the market value. So now conclusion, okay, what is a suitable conclusion? You can give agreeing a market value for asset and liabilities probably best practice during a merger, but this is not always straightforward. It will be little complicated.